Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Welcome in to Make Your Money Matter. I'm your host, Brad Barrett. I'm also managing director and partner here at One Capital Management. And our goal with this show each and every week is to help you create a better relationship with your money. As we end this year, 2023, we're a couple weeks away from 2024. I want to talk about something that we've been heavily discussing here at our firm and our investment committee, as well as with our clients. And that's about what the Federal Reserve should be doing next year. What should the Fed do? Raise interest rates, lower interest rates, hold. I'm going to talk about that today because I think understanding how we got here, really, and then what we are looking for into next year matters, I think, a lot when it comes to your perception of where you might be in your financial world. Maybe you're looking to buy, maybe you're looking to move. All those have different problem and pain points with regards to the current rates. But I think resetting your mindset as to what we should be seeing from the macro, kind of the global view, if you kind of open up your window and to look at it all, might be a great perspective. But before we get started, make sure to go to our website at onecapital.com. You can click on the media tab, and there you can download and subscribe to the Make Your Money Matter show. You can also download our show on Spotify or SoundCloud or the Apple app on your phone or Google podcast. You can also leave us a message, leave us a review, help us share this podcast with more people. And with that, let's get started. Okay, and starting today in this week's show, I thought a lot about this, and I'm going to say something a little bit controversial, so maybe I'll shake your bones a little bit, and maybe I'm speaking to somebody out there, but I'm going to say something as we started this conversation about what the Fed should do. Friends, I think for the first time in probably 15 years, I've been doing this in the financial services industry for now 20 years, probably the 15 years of that has been artificially low, and I say that word appropriately, artificially low interest rates for over 15 years now. So again, I think in roughly 15 years, interest rates in the United States are actually about right. Now, I know many of you right now are thinking, oh my gosh, how could you say that? You know, I'm trying to buy a second property or refinance on a house, or I'm stuck in a low interest rate mortgage and I want to move, but I can't because of higher interest rates. I understand that it hurts a lot of us, but I think it's important to understand how we got here, okay? So the first thing I want to share is in economics, we call it the neutral or natural rate. Now, there's a rule also called the Taylor rule, and the Taylor rule is a monetary policy, which means, it's stabilized when the nominal interest rate is higher or lower than the increase or decrease in inflation. Or said differently, the Taylor rule prescribes a relatively high interest rate when actual inflation is higher than the inflation target. So it's important to think about this because these models that we go through in economics to study these things rely on data, but a lot of that data, friends, is still distorted by COVID. Now, a simpler approach to this that I want to make for today is to assume interest rates should be inflation plus. So we'll call it that, okay? Just when you're talking to your friends now, just think in your head, inflation plus. Okay, what does that mean, Brad? So if we judge current inflation using an average of the median CPI, the consumer price index right now, which is, by the way, is up about 5.3% from a year ago, and we also use the overall CPI, which again is up 3.2% from a year ago, we get a number that's 4.2% right now currently. Now, plus 1%, if you think about it, remember, inflation plus says rates should be about 5.2%. And friends, that's almost exactly where the federal funds rate is today. Now, here's the big change, okay? So between 2008, we're going back in history for a second, okay? Between 2008 and today, the Federal Reserve held the Fed funds rate below inflation roughly 83% of the time. Now, friends, these excessively low rates have created problems. We know this. We've been talking about it. Like most of us are just saying it flippantly, like we can't just print money to get our ways out of this, right? And that's what's happening. We held rates so low for so long for a majority of the time. Banks have, if you look at their balance sheets, right, have hundreds of billions of dollars of mark-to-market losses and government-funded Green New Deal projects, right, frankly, that's out there. They're all facing serious problems because they are not profitable at current neutral interest rates. So in other words, holding rates down artificially, like the Fed did for years, may make things look okay, but it can't last forever. And I've shared this often on our podcast over the past really couple years. I've been doing this now 4 years now on this show. And I'm thinking about this a lot as I look back at my episodes when I was doing in 2020 and 2021, around COVID, around inflation, that this was a reckoning. We can't keep things artificially. You didn't hear that word on by accident, right? This word artificial, it was stuck in there for a while, and we've been hearing it for years. And this is why. It may make things look okay, but it can't last forever. Now, this isn't all a doom and gloom episode this week. I'm going to share with you, how we need to be looking at this longer term. But I want to share something here. At the same time, okay, the Fed grew the M2 measure of money. They grew it rapidly, as I've been talking about often, in the years 2020 and 2021, that we saw inflation. It was easy to see coming, okay? Again, I'm just going to put that out there. But now the M2 measure of money is actually contracting, which is good. I've talked about this a lot, that it's not just inflation and lowering interest rates to reduce that. It's also reducing the amount of money in the system, which is what we know as M2. That's the calculation of all consumer deposits, cash accounts, savings accounts that are in the system. And it's actually contracting now, which is good. So with money contracting and interest rates near their what we would call normal, it seems appropriate, in my opinion, and this is just an opinion, okay? And we've been talking to a lot of economists out there, to pause. Not necessarily raise and not necessarily lower, but to pause. And we just saw that recently in the last Fed funds meeting. So we're going to see that, I think, coming up. And especially given the fact that tighter money seems to be helping the inflation come back down from its post-COVID spike. But this, at the same time, it is certainly not time to, I would say, claim victory and return to an environment of artificially low rates. I think a lot of us, we're thinking about this like, okay, we want to get back down to 3%. Look, I'm not a guy that's never going to say never, but I would be hard pressed to see that we're going to see sub 3% anytime soon in our economy. Again, artificially low. And I don't think it's a time, again, to claim victory that inflation's coming down. We won this battle and all is good. Let's go back to lower rates, right? That would risk repeating, I think, and many of us think here at the firm, that would risk us repeating the 70s, right? When Arthur Burns cut rates before really eradicating actual inflation. And if, as we suspect, the U.S. economy enters into a recession, again, this might be a milder one now that we're looking at a softer landing, and as well as the political pressure I think we're going to see next year on the Fed to cut rates and maybe restart quantitative easing, it will all be intense next year. You're going to see a lot of the rhetoric, and I just want to share this at the end of the year. Here, we're in December, we're coming up on the new year in a couple weeks. We're going to see, mark my words, okay, we're going to see a lot of narrative and a lot of just hypotheses around when and how much and all these things. We have to remember that pausing might actually be a good thing. And I think actually it would be a big mistake to reduce rates, dramatically unless inflation continues to fall and thereby, again, back to the rule I just mentioned at the top of the show, right? Reduce the neutral interest rate. Because all it would do is continue the mistakes of the past 15 years. Now, we've had a good market run in the past 15 years, but we're also in this situation because of artificially low interest rates. Now, granted, COVID and the pandemic did not help this, but still, you can see that we can't have it forever.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
Now, one interesting thing that I think that, we've all kind of observed, is how much bank regulators, federal members, right, the Treasury officials have all shifted their thinking. So back in 2008, right, let's go back there for a second. Remember the guy named Hank Paulson, Ben Bernanke, right, and Sheila Bair? These were all the names that were going around that time period. Those might all ring a bell. They religiously adhered to what's called mark-to-market accounting. Now, we still, if you look at it, there's a lot of things to glean back on when you look at it. This accounting convention for the financial panic that ensued, frankly, but that panic was used to justify growing the Fed's balance sheet by trillions of dollars with quantitative easing and the support of TARP. Remember that? Which grew the size of the overall federal government. So we had to get ourselves out of that. Okay, this is not that far away, or we're still dealing from ramifications there. Now, these policies, if you look back at them, okay, and I know I'm getting a little data driven today and a little heavy on the economics, but I think it's important to understand this in concept as you look at your money and you look at your future, okay? These policies were supposed to, make the U.S. financial system safer, but I'm not sure that they did. Now, that's speculative, but, that's what they were intended to do because the Fed became so powerful and flooded the banking system with deposits at, again, artificially low rates the bank balance sheets, basically, they blew up. They have an estimated $675 billion in losses on them, on the balance sheet. Now, interestingly, and thankfully, I think, banks don't have to mark their assets to market anymore. It would wipe out almost a third of bank capital if you think about that. It's an accounting thing. But what happened to all these mark-to-market believers, right? The Bernankes, the Paulsons, the Bears. What happened to them? Did they only believe in mark-to-market accounting when they could blame it on the banks? You know, now that is clear, I think the Fed's policies caused the losses. You know, I guess it's for all of us to say it. I don't want to throw shade here, but it's like, are they trying to avoid the blame here? Because again, I always said this during those years because I was an advisor. I was in the financial services industry at that time. You know, when Bernanke in particular is left with this situation as our Fed chairman, you know, what do you do, right? Do you allow the run on the banks to happen and us go into, you know, a depression? So it's kind of hard to place blame here, but you also have to like take stock of what you've done and allow us to get out of it, right? Look, the bottom line I want to share here heading into 2024, when it comes to the Federal Reserve, the Fed funds rate, right, is that I think those who think the Fed can just manage its way out of this easily, you know, cutting rates to offset the pain of recession or avoid one entirely or to appease some political party heading into an election, it might not be the right move. And I think, I'm hoping, I'm praying, friends, and I think with Powell, there's been a lot of frustration this year, but I think his slow approach to lowering is actually helping us in hindsight. Many seem to have submitted, I think, to state-run capitalism, and I'm not, you know, going to say one way or the other, but history shows us it has never really worked. So we don't want to go on something that we know doesn't work here. The Fed is likely, I think, and I'll put a bow on it this way, to do nothing. And friends, I think for all of us, sometimes doing nothing may actually be the right move. We're so in this environment, the society nowadays, we have to do something to correct it or to adjust course or so on and so forth. But the move here, again, back to the top of the show, just on economics, the nominal rate, the neutral rate, you know, says it should be in or around where inflation is, which means our rates where they're at right now is actually on par. We want the inflation to come down. If the inflation comes down, guess what? We can lower rates. Because here's what happens. If you lower rates too fast, take real estate. It's a great example, right? If you lower rates too fast, you're going to get a prop up in appreciation rates or value in your real estate. And then you got a big problem because, yeah, it may be a little bit more affordable on the interest rate, but now it's unaffordable on the buy price. So they have to, you know, tread this line to make sure that they stay in this nominal neutral rate. And I just wanted to share that today just because everyone does the rhetoric out there like lowering rates and they're thinking about it singularly. As always with this show, I want you to be educated. I want you to know behind the curtains, if you will. And a part of my job here as the host of our show, as well as an advisor here at One Capital on our investment committee, I try to take notes and I try to glean all the things that we're talking about here, as well as with clients, and formulate a great content to give you that behind the scenes, behind the curtains look around what you actually should be considering. It also might alleviate some pain points for you. How many of you right now are struggling with, oh my gosh, maybe you're stuck in a low interest rate right now, which is a good thing, but you wanted to move or you wanted to do something and now you can't because it's unaffordable because interest rate is higher, or vice versa, you don't own and now it's unaffordable because the rates are just so high. I understand this, but if you think about it logically, again, this is just numbers, okay? Where the inflation is right now, using the CPI median numbers of right around 4.2%, okay? And if you think about it plus one, as I always share, right, that's the nominal rate, we're at the right rates right now from an economics perspective. I know there's going to be pressure from everybody, from voters next year and all this kind of stuff going into political season to lower it. And I just hope that our Federal Reserve does the right thing by lowering it appropriately relative to the nominal rate. Otherwise, we have bigger issues. Think 1970s, think hyperinflation, not good things. So again, this is a good concept. Share this message. Talk to people about this because it's like, it might actually alleviate some pain points. If you're struggling and holding on to like, I just can't wait for that first federal rate cut or something like that, right? Be careful. It's one of those things like, be careful what you wish for. Okay. And I do think, again, back to the notion of today is the do nothing approach, of holding that position in 2024 might actually be the right move and not a bad thing. Hey, I want to thank you for listening to the Make Your Money Matter show. As always, before acting on anything discussed today, speak with a financial professional near you about your specific situation. Or again, if you'd like our help, you can reach us at 805-410-5454. And until next week, always remember to make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.